What's going on, guys? This is Chandler Smith, and I am so pumped about this video. Now, it's not because I like taxes. As a matter of fact, it's the opposite. It's because I love getting out of paying taxes because I've invested in real estate. And so in this video, I'm gonna show you how investing in real estate, I don't have to pay any tax on any of the income that comes from my real estate investments. I'm also going to show you a loophole that helps me not only avoid taxes on my investments, but how I use those investments to avoid tax on my active income from my other job. So with all of that being said, let's jump into it. All right, guys, for those of you that are new to the channel, you need to know up front, I'm not a lawyer, I'm not an accountant, I am just a real estate investor that owns 99 units of rental real estate. In this video, I'm gonna show you how I don't pay any tax on my cash flow, which is hundreds of thousands of dollars coming from my real estate, and how owning that real estate has helped me to avoid other tax from my job as a regional sales manager. Now, the other reason I'm so hyped about this video is I've got an announcement for you. I have decided to release a course on investing in real estate. It's going to be the CDS Real Estate Investing course. Very creative, I know. And in this course, I'm gonna show you everything that you need to know to go from absolutely zero properties to owning over 100 doors of rental real estate and cash flowing hundreds of thousands of dollars every single year. Now, originally I didn't think I was going to do a course. However, I have had tons of people ask lately for me to put together an organized course that they can buy because they've liked a lot of the other content I've put out on YouTube. So I know there are gonna be haters, I get it. However, I am so passionate about this and I am putting dozens and dozens and dozens of hours into creating the perfect course so that whether you're a first-time real estate investor or you've been real estate investing for years, this course will help you to scale your business and get to the point where you own over 100 doors of rental real estate and you are cash flowing like crazy. Now, here is the catch. This course is going to be sold for $500. Now, I think it's worth $1,000. However, I'm gonna sell it for $500 for the entire course. However, I have got some incredible OG followers on this YouTube channel that have been absurdly faithful. They've come and liked all of the videos, they've subscribed to my channel, and because of that, I'm going to do an early release of this course just for those people. And so here's the deal. I'm not gonna give you 50% off, all right? I'm not gonna give you 60% off. I'm gonna knock off a full $400 off of this course, and I'm gonna sell it for just 99 bucks to all of those people that are watching these videos and that have faithfully watched all of my other videos. So if you're new to the channel, you're getting lucky. But those of you that have watched forever, thank you so much. It means the world. You are the only reason that I could do this channel and that I've been able to experience all of the joys of talking about my passion on YouTube. And so because of that, if you sign up now, and I'm gonna put a link down below, if you sign up now, the course will only be $99 for you. Now, this is only going to be this way. Now, this will only be this way for 1 week. After a week, the price is going to jump up, and I'm still gonna be pre-selling the course because the course won't go live until July 10th. And so you're gonna pay in advance, you're pre-buying the course, and you'll have full access to it as of July 10th. However, I really wanted to give back to those of you that have just been incredible. So if you're interested, the link is down in the description. If you guys have any questions about the course, let me know in the comments, but that link is gonna give you a pretty good rundown of everything that the course is going to have. The last thing I wanted to say before I get into the video is thank you so much for those of you that consistently watch the channel. I absolutely love doing these videos. I love the feedback that I've gotten from you, and I want to be completely open to your feedback moving forward. Now, for those of you that are getting this deal on the course and that end up signing up, here's what's great about being one of those people that buys early. I'm going to have open communication with you via email, and anything that you want added to the course, I want to know about it, and I promise you we're going to fix it, we're going to tweak it, we're going to make it better, because I want you to get the best deal ever by pre-signing up for this course, because you are going to get access to a course that I'm not going to try and upsell you later. I want everything that you need in this course to go from no doors to over 100 doors of rental real estate, regardless of where you are in the journey. So guys, thank you so much. I'm way excited about this course, and the link will be down in the description if you want to go and pre-sign up. Again, the course won't be coming out until July 10th, but you can get it for 99 bucks by clicking the link below. Now, with all of that being said, let's talk about taxes. The only time we're going to talk about taxes and be absolutely pumped about that. So before I dive into all of the huge advantages of investing in real estate and how you're going to save a ton on taxes, I want to give you a brief synopsis of how taxes work, because I know a lot of people, they go to their accountant, they take care of them, but there's a basic understanding you need to have so that you can apply this principle. So here's how it works. First off, you're broken up, whether you're single, whether you're married, there are a bunch of different brackets depending on your situation. If you're single, for instance, you're gonna go into that bracket, and it's the same for all of them. You have different brackets on your way up, and the percentage changes. So if you make no money, you're not paying any tax. Then it's gonna go up to where you're paying 10% or 12% or 22% or 24%, and it goes all the way up to 37%. Now, here's how it works, all right? If you get all the way to the top, that doesn't mean you're paying 37% on all of your income. In each bracket, you're only paying that percentage. And so at the top, that's where you're paying the most, and you want to do whatever you can to eliminate these higher tax brackets. Now, that doesn't mean make less money. That's a total stupid thing to do that stupid people say, where they're like, oh, the tax system incentivized me to make less. Well, here's the deal. Even if you tap it out, you're just losing 37%. It's not like you're losing 100% of your income in that top bracket. And so you still want to make as much as you can. However, if you can find ways to lower and eliminate those top brackets, you're going to be in a much better place. Now, here is the big misconception with paying taxes. Everyone will say, oh, my accountant's incredible, I didn't have to pay anything in taxes. They are doing one of a couple different things. Either they are saying that you have way high expenses, and those are either real or not. If they're not, then you're just lying, and if you get audited, you're totally screwed. So first off, if your accountant is just saying, hey, write all of this stuff off, you'll be good. No. If you didn't actually spend that money, you're gonna end up getting screwed. Or if you don't get screwed, you're just a dishonest piece of crap. So don't do that, all right? That's the first option. The other option is your accountant comes to you and says, look, go buy more things for your business. Buy more computers, buy more paper, buy these things that your business is going to use, and we can use those things against your taxes. We can take them off of your taxable income. Now, what both of these strategies do, whether they're honest or dishonest, is it takes you from making, let's say, $500,000, and it drops it down to where you only made $450,000. It took $50,000 off of your taxable income. So if you're gonna be paying 37% in taxes because of where your bracket is at, then you're just not going to be paying the 37% on that $50,000. So if your accountant says, look, do you need a computer? And you say, no, we've got a computer that'll work the next 5 years. And he says, well, go buy a computer so you don't have to pay your taxes. That's totally stupid, because now you're buying something you don't need to save 37% when you just spent 100% of that income to save that 37%. Now, you got a new computer out of the deal, but if you didn't want that or didn't need that, then that's a stupid way to do things. So those are the first two. Now, if you're saying you bought a computer when you really didn't, then that's just dishonest, but it will save you 37%. Am I suggesting doing that? No, of course not. Do not be dishonest in your taxes, or you're gonna end up getting totally screwed. That's just the way that things are, okay? Now, the last way to avoid taxes, and I'm sure there are others, all right? You can talk to your accountant. There are a ton of different ways to try and avoid things, but essentially all that you're doing is either spending money because the government is incentivizing you to spend money on your business, so you have to pay less tax, or they're incentivizing you to do something where you can push those taxes down the road. The biggest thing you have to remember when looking at taxes is the government is trying to get you to respond in a certain way. There is no perfect loophole, all right? The government has it set up to where they are trying to use you as a pawn and get you to do what they want you to do. For example, when you spend money on something for your business, the government wanted you to spend that money. That's why they're incentivizing you to do it. And it isn't really income because it's going back into your business. When you invest in the stock market and you make a return that you pull out, you don't have to pay tax as if it's ordinary income according to this normal bracket. You have to pay on a lower bracket called long-term capital gains tax. Now, once again, this is the government incentivizing you to do something. They're incentivizing you to invest in the stock market. They're also saying, hey, maybe this is a little higher risk because they're doing this, because they're keeping our economy going, we're not going to tax them as high, all right? So everything the government does, it's to incentivize you. And anytime you think you're working a loophole, it's because they're trying to get you to act in a certain way. Now, at this point, you should be saying, well, Chandler, you just said investing in real estate is absolutely incredible, and you're gonna tell us all of these incredible things about saving money on taxes because you've invested in real estate. That is true, and that is because the government wants you to invest in these things. However, all that you're doing when you invest in real estate is you're kicking paying the tax down the road. All right, a 1031 exchange, that's all it does. When you sell a property and you move that money over to a new property, you're not getting out of paying the tax. You're just moving that tax over and not having to pay it on your profit when you moved it from one property to another property, but they're keeping track. All right. Now, when it comes to real estate investing, it's different. The government does want you to do this. However, the way that I'm saving in tax is not because they're saying I never have to pay that tax. They have just created a loophole so that I can kick the tax down the road. So my goal with this tax strategy is to never pay the tax I have kicked down the road. Now, I know a lot of you are saying, what do you mean, Chandler? Well, here's the deal. Every time I buy a property and that property goes up in value, or I make a return on that property, the government has let me use depreciation against that income. So, for example, let's say I buy a property for $100,000. And let's say in 1 year, I make $5,000 in cash flow off of that property. Yes, that's a crappy return. Yes, I would never buy a property like that. However, with that being the case, that $5,000 should be taxed as ordinary income. It should just be put to the top of your tax bracket and you should have to pay that percentage on it. However, the government allows you to use depreciation against that income. Now, what is depreciation? Depreciation is the government saying, hey, you bought this property. Every year that it's out there, it is losing value. Now, is that true? No, not at all, especially if you're maintaining your properties. However, the government has said you can depreciate that property over 28 and a half years. Now, here's the catch. If you buy a property for $100,000, you use that depreciation every year, which is going to offset the income you made because you can use the depreciation against that income or that $5,000 I was talking about. So if you've got $7,000 of depreciation and you only had $5,000 of income, you don't have to pay any tax. As a matter of fact, you've got an extra $2,000 of not tax. And I'm not going to get into that. You can talk to your accountant about how you use that. However, I am going to keep this very simple so you understand what's happening. Now, what happens is once you get to the point where you have used all $100,000 of depreciation, because you're depreciating it over a 28-year schedule, you get to the point where you don't have depreciation anymore, okay? You can't use it against your income. So once that depreciation is gone, you would now have to pay tax on income created by that property. The same goes as if you were going to sell the property. So if you've been depreciating a property, you depreciate the whole $100,000 and now 30 years down the road, you sell that property for $200,000. So double the value, you now have to pay tax on that full $200,000, okay? Because that's what it was worth. That was the money you got back and you use that depreciation against it. All right, so I hope everybody's following me. You bought a $100,000 property, you sold it for $200,000, you had taken $100,000 off in depreciation, so now you owe tax on that $200,000, and that's gonna go to the top of your bracket. So if you're already paying 37% and you sell a property, now you're going to have to pay 37% of that $200,000. Now I know a lot of you are saying, well, Chandler, whoa, that sucks. You're right, but for the first 30 years or 28 and a half years, because that's how long you can depreciate your property, you aren't paying any tax on the income you're getting from your property. Now here is where you need to really understand this principle, is if in your mind you're saying, well, that's not a good deal, you're right, it's never a good deal. You always get screwed with taxes. However, here is where the deal gets good. That means you can cash flow all of this time without paying tax on it. That means your property can go up in value without paying tax on it unless you sell it. But the government has given us something called a 1031 exchange. Now what this does is it means that if you get to the end of your 28 and a half years and you decide to sell the property, but you do a 1031 exchange, you can take that full $200,000 in value. You can use it as a down payment on a $1 million property. And now you can depreciate that $1 million property, but instead of being able to depreciate the full $1 million, you only have $800,000 worth that you can depreciate. Now I know a lot of you are saying, well, Chandler, that's a bummer. You only have $800,000. You could have had $1 million. No. I just took $200,000 and who knows how much in cash flow over that 28 years, and I moved all of that without ever paying tax into a new property that I was able to buy with money I never had to pay tax on, and now I get to continue to use that $800,000, so I'm not paying tax again on the cash flow by that new property. So now let's fast forward another 28 and a half years. At this point, I'm probably dead, so I don't care because I never had to pay tax.
Win. No.
Now you're saying, well, what about your kids? You totally screwed them over. No, I didn't. I just gave them a ton of free money that they're gonna have to pay tax on. Oh no, now they own a property that's probably gone up and doubled again, so they own a $2 million property, and even if they've got to pay their 37% in taxes, and there's a whole lot more that goes into that in the future because of taxes for giving your kids stuff, and I'm not gonna go into that, but they still own a $2 million property, and I never had to pay any taxes. Now here's where it gets really exciting. Within your property, you have things like your oven, all right? You have things like your dishwasher. You have things like your sink, your paint, your carpet. All of these things that are individually expensed. Now here's the deal. You can expense them all on the 28 and a half year schedule. However, if you want to get really creative, you do something called cost segregation. Now what this means is when you buy a property, instead of saying, oh, this property is worth $100,000, I'm going to depreciate that $100,000 over a 28 and a half year schedule, you can say, well, here's the deal. The actual property is only worth this much. And when I say this much, I'm not guessing. I use a company that goes in and looks at the property and says what stuff's worth. And they're gonna say, well, the oven's worth this, okay? The carpet's worth this. The this is this. They're gonna go through all of this and say what each of those are worth. And then when you go to the tax code is gonna say, well, the property you have to depreciate over 28 and a half year schedule. However, that oven, it's only gonna last 3 years. So you can depreciate it over 3 years, all right? Now what you do is if you cost segregate everything, you can take a big chunk of this property to get a lot more depreciation. So earlier I said, hey, maybe you're taking $5,000 or $7,000 on the 28 and a half year schedule. Well, now you could take $15,000 in depreciation in your first year owning the property. Now keep in mind that this means you're not gonna have 28 years before you run out of depreciation. You're gonna run out of it a lot quicker. However, there is a strategy, and talk to your accountant about this because there's lots of things you have to do, but if you use depreciation and you speed it up and you use it all up on your rental income, you can use the extra against your active income. Now, there are a lot of things you have to do to be able to do this, and I'm not gonna talk about them in this video because it would take too long and I wanna keep it simple. But what you need to recognize is if you're always buying new property, you can always keep up with enough depreciation to cover your rental income. And if you're buying property fast enough like I have, you can not only get all of your rental income for free, but you can get in a place where now you're not paying taxes on that high bracket. So for me, if I'm in the 37% bracket, but I can knock that down so that I'm only paying taxes up to the 25% bracket because I'm using that depreciation from my properties against my active income. Now, not only am I making cash flow, appreciation, principal pay down, but I'm not paying any tax on any of that. And I'm using these properties to not pay tax on my active income, and I'm doing it completely legally. Now here's the deal. If I stop buying real estate and I use up all my depreciation, well, now I'm in a situation where I'm gonna have to pay taxes on everything, including my rental income. But I have sat down with my accountant, I've planned my strategy, and I am always going to be buying real estate. I'm always going to do it. I'm always going to be building an empire. I'm always going to be getting more depreciation that I can use. And because I'm using this strategy, it's helping me to pay a lot less tax in a very legal, audit-proof way so that I can amass wealth much more quickly and buy a lot more property a lot more quickly because I'm paying less taxes. So there is a very general overview of how you can avoid a ton of taxes because you invested in real estate. Now, I'm gonna dive into this way more in detail in my course. So again, if you wanna get it for just 99 bucks, click the link below. You're not gonna actually get access to that course until July 10th. However, I can promise you, I'm gonna make sure that this course is worth $1,000. And for all of you that have been super faithful, you're gonna get it for just 99 bucks. And please, if you've got any questions about this concept in this video or about the course, let me know in the comments. And remember, push that like button, subscribe to the channel, and I'll look forward to seeing you in the future videos where my goal is to help you to create a huge passive income. Thanks so much, guys. Have a great day.